Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Loren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Hello, everyone. Welcome back to our repeat customers, and thanks for joining to any new listeners checking us out. As always, I am your host, Loren Sherman, and today we're talking about taxes. Specifically, we're talking about the idea of looking at taxes from a rear view mirror approach versus a windshield approach. As we often do, I'm going to start us off with a story. Bill, a CPA, and Marge, a retired nurse, decided this year to deviate from their normal vacation of heading to the Black Hills in South Dakota each year. Instead, they made the choice to head south to Nashville, Tennessee. With Marge driving and Bill sitting passenger with his trusty Atlas, they figured they'd have no trouble navigating the new route as a team. There was just one problem. Every time Marge asked for the next turn, Bill would respond with the name of the road they were previously on, or the town they had just driven through. After many close calls and several U-turns, Marge had had enough and switched spots with Bill for the rest of the drive. The remainder of the trip was a breeze, with Marge giving Bill plenty of heads up anytime a turn was coming up and even let him know what lane he needed to be in. While Bill had lost his driving privileges, he learned a valuable lesson. It is better to look out the windshield than in the rear view mirror when giving directions. Of course, in real life, no one is going to give directions by looking backward and remarking where you've been, but the joke of the story is that Bill was a CPA. And accountants tend to offer tax guidance based on what has already happened. This is only natural since they must use real, hard numbers for a tax return. I have told different variations of this joke to many of our clients, CPAs, over the years, and the reaction I've gotten is anything from a cold stare to a hearty chuckle. My biggest backfire so far was attempting a condensed version of this joke over the phone with a CPA that I had just met, and I got complete radio silence on the other end. I thought we got disconnected until he replied, "Nope, still here." We can laugh about it now as we have actually become friends and still work together a couple of years later. The reality is, we love working with CPAs. They provide critical support for our financial planning advice and are an important part of any client's team. At Integrity Wealth Management, our process dedicates a lot of time and energy into retirement tax planning. We have multiple certified financial planners, federally authorized tax practitioner on staff, and use some of the most cutting-edge tax software on the market. We feel that this blend of technology paired with the personal touch of human advisors is the best approach. But part of being a tax-centric firm is that we attract retirees who are frustrated with how much taxes they are paying in retirement. Sometimes they want to point the finger at their CPA for this problem, or perhaps pass the blame to the advisor they were using before they found us. I think this is a little unfair. Your CPA's job is to look in the rear view mirror and calculate taxes 1 year at a time. Further, most brokerage firms and direct-to-custodian relationships are prohibited from offering tax guidance. For example, if you visit the Frequently Asked Questions tab of one brokerage firm, you'll find the following statement. Edward Jones, its employees, and financial advisors cannot provide tax or legal advice. You should consult your attorney or qualified tax advisor regarding your situation. Now, this isn't to pick on Ed Jones. As I mentioned, this is the case with most brokerage firms and investment-only relationships. Rear view mirror tax planning. In short, a rear view mirror tax planning approach always looks to bring down your current tax bill for that particular year. While this can offer a bit of immediate relief, let me pose a question to you. Would you be willing to trade a $50,000 tax savings over the course of the next 10 years for a $7,000 tax savings that happens only once in year one? Of course you wouldn't. Everyone would take the $50,000 tax savings, but when is the last time someone sat down with you and looked at your lifetime tax for your retirement as a whole? Don't feel bad if you've never done this, as the answer most people say is never. Most of the retirees we talk with are shocked to see how small changes can save them not just thousands of dollars in taxes over the course of their retirement, but hundreds of thousands of dollars. Just recently, our firm worked with a client who had close to $2 million of assets. Based on taking a windshield approach and optimizing his taxes, he was able to increase his lifetime portfolio by an additional $1.5 million. This isn't from projecting higher investment returns or making other portfolio changes. This is only from optimizing one aspect of his planning with a windshield approach to taxes. Now, of course, he did a great job of saving for retirement, so not everyone will have $2 million, and not everyone will have as dramatic of a difference between their current plan and an optimized tax strategy. The point is, if we're not taking a windshield approach in retirement, we're leaving dollars to the government instead of our kids, grandkids, or even for our own enjoyment in retirement. At our firm, we work hand in hand with CPAs to not only optimize your tax bill for the current year, but develop a tax strategy for decades to come. With a windshield approach, our strategy is to pay the IRS what they're owed, but not leave a tip. So where do we go from here? It is with our windshield planning approach in mind that we request a completed tax return from our client CPAs to put together a proactive plan for the remainder of the year, always with the big picture in mind. From there, we can start to plan for future years and even decades into retirement. One of the frustrating parts about taxes is that the number of variables is seemingly endless. If we take a distribution here, I lose my ACA health credits costing me $15,000 in back premiums. If I take income from this account, all of a sudden I'm paying more for Medicare and for my drug plan. If I sell this stock, I'm getting hit with short-term gains and losing a third of my profits. If we adjust one lever, 3 others can often move by accident. This is where we use state-of-the-art tax technology and software, have an in-house tax practitioner, and leverage your current CPA relationship to make sure your team as a whole is on the same page. Most CPAs love working with a tax-sensitive financial advisor, as we can help make their job easier rather than adding more heavy lifting for them to do. If you click on the link Windshield Approach in our show notes, you'll see that optimizing your taxes with a windshield perspective can have big implications for your overall retirement plan. It could mean the difference between having enough versus running out too early, or between having just enough versus passing additional wealth to kids, grandkids, and charitable organizations that matter most to you. I'll talk through this illustration that's linked in the show notes just for a moment. First off, the illustrated situation isn't a once-in-a-lifetime situation, but rather a relatively common scenario we see when working with our client CPAs. In this example, these retirees started with about $2 million between all accounts. Their default retirement income strategy was not integrated with their tax planning and therefore left a lot to be desired. They did an excellent job saving and investing over the years, with a hypothetical ending portfolio value of about $5.6 million that they would pass to their heirs. This is without a tax strategy, so they're already in good shape. But once we paired our windshield tax planning approach with their retirement income strategy, they created a little more than $1.5 million extra in ending portfolio value. That's a whopping 28% more that they could enjoy in retirement, pass to future generations, or use any way that they see fit. Once again, it's all about paying the IRS what they are owed, but enjoying your hard-earned money however you'd like, rather than leaving a tip. If you'd like to see what a windshield tax plan would look like for you, take the first step by completing about a 2 or 3 minute questionnaire that you'll find in the show notes titled 9 Retirement Questions. That's all I have for you today. We will be back in 2 weeks to chat more. Until then, go ahead and check out our show notes for any links or the illustrations that we discussed on today's episode. Also, feel free to meet our team by heading over to healthywealthywiseretirement.com.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Loren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.